Hi folks, now last week I was scouring through the YouTube videos, pretty much I guess like you were doing today before you found this video today. Basically seeing what was out there for beginners possibly thinking about starting off in the Forex markets. Now for those that follow me know that I've done multiple videos over the years. Some of them have been quite well received, over 1 million views. I think the top one is coming up for 2 million views. 230,000 followers I think it is. But it dawned on me what was certainly missing out there was a concise like crash course in Forex trading. But the challenge for me was to get this out in a reasonably short video with not wanting to bore people, but equally not wanting to leave out some crucial parts about the Forex markets. That's why I decided to put this video together. I really hope it works. And now, of course, you're not going to learn how to become a consistently profitable Forex trader in just a 20-minute video here on YouTube. But what I want to do is to show you what the Forex market is all about. If it makes sense, if it sounds like something that you want to develop further, then there are plenty of places where you can do just that, including with us here as well. Now, I'm also interested to hear your views as well, so make sure you leave a comment after this video. If you enjoy the video, please give me a thumbs up. If you don't, give me a thumbs down at the end. Now, don't forget to subscribe to the channel if you don't already do so. And all the YouTubers say, don't forget to hit that bell notification just in case you don't want to miss the next video when it's been released. Don't forget to follow us on Instagram and Twitter, and of course, follow us on Facebook. If you follow us on Facebook, you can tune in live every 2 p.m. London time for a live event where we discuss market opportunities for the week ahead. Now, as a special bonus, I will be coming on live every Monday at 3 p.m. London time here on the YouTube channel, discussing trading opportunities, looking at some education as well. Your chance to interact with me on a live basis, so you get your questions answered in real time. Another brilliant reason why you should be subscribing to the channel. Right, without further ado, let's get into Forex for beginners. Hi guys, right, today is my biggest YouTube challenge to date. I'm going to show you over the next 25 minutes everything that I know about the Forex market so that you can make an informed decision whether it's something you want to delve deeper into. Now, joking aside, there is so much to know when it comes to trading in general, or indeed the Forex market. So what this is intended to do is to basically skim over some of these topics. I'm going to skim over the most important topics. If you want more information, of course, you can subscribe to the channel and get all the other information in there that I put out on the channel. I've covered a lot of these topics in much more detail on the channel here, and also, of course, in our trading room as well, should you wish to come over there. But basically, this is just like a quick summary of everything you need to know. And here are the topics that I want to cover with you today. So the what, the why, and the where. Why are we trading the Forex market? What are Forex pairs? Often people ask me, what is a Forex pair? Lots and leverage. We're going to demystify the Forex price quote, sometimes a bit confusing for some people. Technical analysis versus fundamental analysis. We're going to look at brokers and the different trading platforms you can use. In particular, I want to show you the MT4, the MT5 trading platform. That's the platform that most beginner traders use these days. Then we'll look at the Forex price chart, what the Forex price actually looks like on a chart, how to read them and so forth. We'll look at the different order types, different strategies that you can use. Strategies, basically a set of rules that will allow you to enter and exit trades. We'll look at the risk management, the psychology tips and challenges. Psychology, one of the most biggest and most important topics of the whole of the trading game. We'll talk about copy trading and signal following. Is it really worthwhile? Will you make money by following signals and copying other people's trading? And then we'll wrap it all up at the end, so then you can make that decision whether you want to continue. Of course, if there are any of the topics here that you want to delve deeper into, as I say, check out the YouTube video. I suggest you watch this video now in its entirety, then watch it again and pause if you want to take notes, because I say we are going to run through it. It's going to be at super fast speed. So what is the Forex market? Well, you may have heard this before. Forex market is the largest financial market in the world today. It has a turnover of almost $6.5 trillion. You see what's happened basically in the last 30 years or so. The growth has been pretty explosive, and it's growing each and every year as well, certainly dwarfing any of the other markets. The nearest market to that is indeed the stock market, which doesn't even come close. So what is the Forex market? Well, in a nutshell, Forex trading is basically the buying of one currency and the selling of another currency. Now, if you think a particular economy is going to do well in the future, or in the next hour, or whatever it is, and you might think that currency will do well as well, then you buy that currency. But when you're buying a currency, you're exchanging it for another currency. So you may be picking a currency that isn't looking so positive in terms of its economy and its outlook. So basically, the Forex market is buying one currency and they're selling another. Unlike if you're buying stocks, you're just basically buying the stock or commodity. You're just basically buying one entity. Forex has two transactions going on at any one time. Now, the chances are you've already traded the Forex market without even knowing it. Now, imagine you want to go on holiday, which I'm sure if you do, you want to change up your currency. You change up your currency if you're going overseas to the currency in which you are traveling to. I live here in the UK. If I want to go to the Big Apple in the USA, I've got to change my pounds for the US dollar in order to facilitate my holiday, my spending. So here I am in the UK, and I want to take £1,000 with me on holiday. So I go to the Bureau de Change, you see them there at the airport, all the prices on the board flickering away, they're changing. They're changing instantly throughout the trading day. They're changing 5 days a week, 24 hours a day. These prices are flickering and changing. The moment I'm changing up and I see the exchange rate on the board, it's 1.3. So my $1,000 buys my £1,000, I should say, buys $1,300, $1,300. Now, let's assume that the holiday doesn't take place. Let's assume, say, the pilots go on strike, or let's assume there's a global pandemic and all the flights have been cancelled. I'm sitting here with all these dollars in the UK. I've got nothing to do with them. Can't spend them here in the UK. I've got to change them back into pounds so I can carry on spending my money. But now the exchange rate has changed. Let's assume the exchange rate has changed from 1.3 to 1.2. Exchange rates are changing, as I say, all the time on the money markets. So now my $1,300 that I'm owning, I've got to buy pounds back, and I buy them back at the prevailing exchange rate, 1.2. So if I divide 1,300 by 1.2, I get 1,083 pounds. So basically, I have made an £83 profit for doing absolutely nothing, purely because the exchange rate has shifted from 1.3 to 1.2. That's the basics behind an FX transaction, a foreign exchange transaction. Slightly different when we're coming to trading it, but that is the basic premise behind Forex. So why the Forex market? First up, ease of access. Forex market is basically decentralized. It means there's no central marketplace. Basically, it's a communication network with all the banks and brokers all putting in their price feeds. And us as retail traders have easy access to this market via brokers. As long as you've got an internet connection, you can use this with a laptop or a smartphone. You can trade from the beach. You often hear people say trading from the beach. I think if you're sitting on the beach, you shouldn't be trading the Forex market. There's plenty of other things you should be doing, but you get the idea. As long as you've got an internet connection, accessing the Forex market these days is indeed very, very easy. And liquidity. I mentioned to you a moment ago about the liquidity. It's a vastly growing market, $6.5 trillion a day. That basically means it's very easy to enter and exit the market. Obviously, the more easy it is, the cheaper it becomes as well. So the liquidity really does assist the retail trader. Cost of entry basically is affected by increased liquidity. More liquidity, cheaper it is. Transaction costs, as I said, very low commissions now. A lot of the brokers are fighting for your business. They want to take your business and they offer very, very low commissions. It's a very competitive market, and the spread between certain currency pairs, more about this in a minute, sometimes can be very, very close. The difference between the buying price and the selling price, very tight. That basically means that the cost of doing business in the Forex market is considerably less than other trading entities. And leverage. Remember I showed you there that example of going on holiday with your £1,000 and you change them into dollars and you make £83. Well, clearly you're not going to be giving up your day job with £83 profit. But with the Forex market, many brokers will offer you high leverage, basically lending you money to trade the market. So basically, if you have an idea of where you think a currency market is going, a currency pair is going, you can use broker leverage to make those gains bigger. Leverage is a double-edged sword. More about that later. Leverage can offer huge returns, but also can kill you as well unless you know how to use it correctly and use it wisely. Trading hours. Forex market is open 24 hours a day, 5.5 days a week, just because it's open 24 hours a day, 5.5 days a week. It doesn't mean you should be trading 24 hours a day. Leads to fatigue, leads to problems, leads to some nasty habits as well sometimes. But it certainly suits those that are on shift work, people that have day jobs, people that are able to spend a few hours a day in front of the screen. So basically it's accessible, unlike a normal stock market that will open at 8 a.m. and close at 4. Forex market's open all day long, 5.5 days. Very easy for you to do this alongside your day job as well. Okay, so the Forex currency pairs that traded in the Forex market. Now, there are typically 8 major currencies that we trade in the Forex market. Now, of course, you can trade all the other currencies as well, the Hong Kong dollars and the Singapore dollars and Norwegian and what have you. But the major currencies that are quoted in the Forex market these days are these major 8. Australian dollar, pound, yen, euro. You see them here on the board. So when you cross-match all these different currency pairs, you have a total of 28 different currency pairs that you can trade. So you can trade the pound against the Aussie, pound against the yen. So basically 28 different currencies. So there's plenty of opportunity for you to get into a strong currency against a weak currency. Plenty of opportunities. If nothing's going on in the euro against the pound, no problem. There might be something going on against the New Zealand against the Swiss. Plenty of opportunities. A little bit more about the Forex pairs now. Basically, they're split between majors and minors. Now, the majors are currency pairs that basically trade against the US dollar. Now, the US dollar is the most actively traded currency on the planet. I think the last time I checked, it basically accounts for about 88% of all foreign exchange transactions have the dollar on one side. So these other 7 currencies against the US dollar are known as the majors. Now, the benefit of trading the majors, because they're most actively traded, is that the volume and liquidity is much greater. So sometimes volume and liquidity might dry up in the less actively traded currency pairs. Against the majors, they have the most volume and the most liquidity because they are the most actively traded. And that basically means you get tighter spreads. The difference between the buying price and the selling price, that is a cost in trading. If you're buying a stock for $5 and then the bid price is $4, well, the cost of entry on that is $1. So the more actively traded currency pair, the majors, the tighter the spread, the less cost it is to trade. So the cost of trading the majors is less. Conversely, if you're trading the minors all the other currency pairs, cost of business is generally more expensive. These are less actively traded, although there are some major opportunities in these as well. The volume and liquidity is less. Okay, the spreads can be wider if you're trading perhaps maybe the New Zealand dollar against the Swiss franc, something like that. Sometimes the spreads will widen in that because it's not so actively traded. So it's fair to say the cost of trading of the minors, everything that doesn't have the US dollar on one side, is generally more expensive. Now I want to talk to you about the Forex price quote. So here is a typical price quote. Here you've got the GBP versus the USD. This is the Great British Pound versus the US dollar, 132.50. Now the first currency in the quote is known as the base currency. The second currency in the quote is known as the quote currency. Don't worry too much about that at this juncture. But the first currency is the base, second is the quote. Now, if you're buying the pound US dollar, it means you're buying the pound and you're selling the US dollar. So whatever you're doing to the currency pair, you're doing basically to the first currency. So if you're buying the pound dollar, it means you're buying that currency and you're exchanging it for that currency there. And the quote currency tells us how much of this currency, the US dollar, is needed to buy one of the base currency. I know this sounds a bit confusing. It will become a lot clearer when you actually look at the prices on a chart. So for example, in this example, the buyer has to pay $1.3250 to buy £1. If you're selling a particular currency pair, you're selling the first currency. In this case, you'll be selling the pound and you'll be buying the US dollar. So remember, whatever you're doing to the currency pair, you're doing predominantly to the first currency. So you're selling the pound, buying the US dollar. And the quote currency tells us how much of this currency you will receive for every unit of the base currency that is sold. In this case, the seller will receive $1.3250 for every pound that he exchanges. So what you really need to know, this is all a bit confusing, but what you really need to know is how much is all this worth? How do you calculate what the value is of this? So basically, let's have a look at what a pip value is worth. Bearing in mind this quote base currency, let's assume here the bid and ask, that's the difference between the buying price and the selling price. Here you see 145.25 to 145.26. The asking price, as always, is going to be higher than the bid price. Let's exchange now. $100,000 at the ask price, it would give you $145,260. This is for one standard contract. In Forex, we talk in terms of contracts. One standard contract is 100,000. I'll talk more about that in a second. The bid currency here is at bid price is 145.25. So 100,000 at 145.25 would equate to 145,250. So you can see here the difference between this is basically $10. That's all you really need to know. Don't worry too much about all that stuff I mentioned. All you need to know is one standard contract, the difference between 25 and 26 is one pip, equate to $10. How you work the calculation out is you simply divide 100,000 by 0.0001, gives you the $10. That basically shows you what a pip is worth. So all you need to really know is this, that when you're trading in Forex, we trade in terms of lots. Now, a standard lot, as I mentioned a moment ago, is 100,000 units. But it doesn't mean you need to trade 100,000 units. You can trade smaller lot sizes than the standard one lot. You could trade a mini lot, for example. A mini lot would be 10 times smaller than a standard lot, in which case you'd be trading 0.1 of a standard lot. And indeed, you can go even smaller than that. You can trade a micro lot, and a micro lot would only be 1,000 units, which would basically be 0.01 of a standard lot. So what you need to know here, if you look at the currency quote, you'll see here a pattern developing. The pip size, i.e. how much you'll make or lose as the price moves one pip, from 25 to 26 on the last screen, you'll see it reflects as 10 of the quote currency. So if you're trading the dollar against the CAD, each pip on a standard lot would be worth 10 Canadian dollars. If you're trading one mini lot, each pip would be worth 1 Canadian dollars. So you can see cost of entry pretty low. And indeed, if you're trading a micro lot, you can trade for low as 10 cents. Some brokers offer that ability as well. So just because one standard lot is 100,000, it doesn't mean you need to be trading that. Here again, you've got the, say for example, the euro against the Swiss. The size of the pip is 10 of the quote currency, 10 Swiss francs, or 1 Swiss franc, or indeed 10 centimes. And of course the euro against the dollar, well, we know that the dollar is the quote currency here. Each pip on a one standard contract would represent $10, $1 and 10 cents. Now, of course, if you're trading and you're using British pounds or you're using another currency, the euro, for example, then you need to obviously convert this into your own particular currency, so you know in your own mind what the size of the transaction will be. But I think what's important to note here is that you don't need vast amounts of money in your trading account in order to access the Forex market. You can literally go down to 10 cents or centimes per pip, depending of course on the broker. Great way to learn. So now let's talk about leverage. I showed you a moment ago when you go on a holiday with $1,000, you change them into US dollars, you made 83 quid, or enough to give up the day job. But the Forex market, you can use leverage. Banks, brokers will lend you money basically to invest in the currency markets. And that's basically what leverage is all about. So for example, if you've got a $1,000 trading account size $1,000, and you're trading one standard lot, which represents 100,000, well, 100,000 divided by 1,000 means you'll be trading with 100 to 1 leverage. Quite high leverage, certainly when you're starting off. And that would equate to $10 a pip. Shows you don't need much to get wrong before you blow up your trading account. You get a trade transaction, 100 pips against you at $10 a pip, you've blown your trading account. So be careful of this leverage. If you're trading, for example, a mini lot, which represents 10,000 units, 0.01, you've still got your $1,000 trading account. That's only 10 to 1 leverage. 10 to 1 leverage much more manageable. Basically, it's $1 a pip. You basically got 1,000 pips to lose before you blow up your trading account. I certainly wouldn't suggest you stay in a position for 1,000 pips against you, but you get the idea. So you can see here that the leverage, high leverage, can actually be a killer if you get it wrong. It can be great if you get it right, but law of large numbers suggests that you won't get it right all of the time. And you can go down even lower. You can go down to microlots. A microlot, 0.01 of a lot. That's basically 1,000 units. 1,000 units on a $1,000 account. That would basically be a 1-to-1 leverage. That would be like going on holiday to the Bureau de Change and exchanging them up from the flashing board there as well. So this is basically what leverage is. Look at the size of the account to the size of the units that you're trading, and that would basically work out the leverage. Now, some brokers out there, they are offering excessive leverage. I've seen some brokers out there offering 500-to-1 leverage, 1,000-to-1 leverage. I think you know what's going to happen there. If you're trading with 1,000-to-1 leverage, chances are when you get it wrong, you are going to blow up the trading account. So leverage is a short, fast way, excessive leverage, I should say, is a short, fast way to the poorhouse if you indeed embark on that. Okay, let's talk about now technical analysis versus fundamental analysis. This is basically how we analyze the markets in order to make an informed decision on whether the price is going up or indeed down. There's basically two ways we analyze the market. As I say, technical or fundamental. This is technical analysis. Technical analysis basically is a method of looking back at a chart, at price behavior on a chart, see what's happened in the past to help us predict what may happen in the future. So we're looking at historical data. So the chart is a visual representation of what price has done in the past by looking at a chart. Okay, price is a result of mass perception of current value. So imagine you've got lots of buyers, lots of sellers all around the world, all trading in the Forex market. What you see on the price chart at that moment in time is the mass sum of all that participation. Are the buyers in control or are the sellers in control? And you can see that very clearly on a chart. Now, there are a number of ways that you can look at price on a chart. And traders these days use what are known as technical indicators to help them, to aid them in predicting the future price movements. Now, these technical indicators come in all shapes, forms and sizes. There's literally hundreds of them. Technical indicators will be created each and every day. Far more out there than I can spend time talking to you with today. I will be talking about some of the more important ones in subsequent videos, so make sure you do subscribe to the channel and then you can catch up and learn more about these really important indicators that traders are using these days. But basically they fall into three main categories really. You've got the trend following indicators, that's like the moving average. You've got the MACD, that's the moving average convergence divergence. You've got the ADX, you've got the ATR. Then you've got the oscillators. The oscillators basically prices oscillate between oversold and overbought. It gives us clues where prices are getting too expensive or indeed too cheap. You've got the momentum, you've got the stochastics and the relative strength index and so forth. You've also got the commodity channel index. Then you've got the miscellaneous. Miscellaneous, I've characterized those as like the support and resistance, pivot points and Fibonacci. That's basically some of the technical indicators that we use as traders. Now, another way that we analyze the markets is using fundamental analysis. So fundamental analysis is basically the macro view, a macro big picture view of a state of a particular country's economy. Is the economy in recession? Is it in a period of growth? Normally, if a country is in recession, normally the currency is under pressure as the central bank has to cut interest rates to support growth. And if a country is booming, then interest rates move and normally the currency should follow as well. Now, in order to determine the economic state of a particular country's economy, we look at economic releases that are released throughout the calendar week. Now, we always look for these, and there's a schedule out. We normally look at that a week in advance to see what is coming out. The main important one, of course, is the non-farm payroll. That's the US unemployment data. Incidentally, these come out at 8:30 Eastern Standard Time, which is 9:30 a.m. In the US for these economic releases in the States. You've got the gross domestic product, GDP, consumer price index, PPI, which is basically inflation, really. And then you've got the durable goods, trade balance, retail sales, retail prices. Again, we spend more time delving into these in more detail on subsequent videos. You can go and check them out if you wish. But the fundamental analysis is basically the macro view of a state of a particular economy to give us the clues where the country's currency may go. So you've got the technical analysis, which is look at charts, and you've got the fundamental analysis, which is looking at this economic news in a particular country. Okay, so now let's look at brokers, MT4 and MT5. Now, there are multiple brokers out there that you can choose to use for your trading. First thing to be said is, if you're trading the Forex market, you do need to have an account with a broker. So you deposit money into the brokerage account, and that will allow you to trade. You'll basically decide on the leverage that you're allowed to use and so forth. But you need a broker in order to access the Forex market. We do have some suggested brokers that you can use, but that is for another time. Interesting to note, you need to know whether the broker is regulated or not regulated. Now, depending of course on where you are in the world, I suggest you go for a regulated broker. Some places in the world there aren't any regulated brokers. You need to find a non-regulated broker. But there are some good non-regulated brokers out there as well, but you certainly need to know that. Also, what you need to consider is the commission charges that they're going to charge. That's basically the cost of doing business. If you're trading one standard contract, it might be $5 per contract or whatever it is. Chances are, if you're starting off, you're going to be trading smaller size. The commission is important, not too important, depending of course on how big the trading account is, but certainly you need to look at that. Also the spreads as well, make sure the spreads are nice and tight. Difference between the buying price and the selling price. Make sure the accounts are segregated. Make sure that your money is safe and it's not going to get wiped out by some rogue trader as well. So always check out to make sure your broker's holding your money in segregated accounts. Check out fast deposits and withdrawals. What I like to do with a broker when I was certainly starting off was deposit a small amount of money and then withdraw it. See how quick it takes for them to give me their money back. I want to make sure that I get my money back when I want my money back. So fast deposits and withdrawals is very important. And then check out their overall customer support. How long does it take for them to get back to you? This day and age, obviously 24/7 customer support. It's quite good to find a broker that's there for you when you need them. All brokerages offer demo accounts and indeed live accounts. A demo account basically means that you are trading with pretend money. You're pretending you're trading with their make-believe money. You can't do any damage. It's a great way to try out your strategies, get familiar with the trading platform and so forth. There's two schools of thought. A lot of people say you should only trade with real money because it makes it feel real. My attitude is, if you're starting off in trading, start off with a demo account. If you can't make money on a demo, you're certainly not going to make money on a live account. Making money on a demo doesn't mean you'll definitely make money on the live account, but certainly the other way around certainly works. If you're not making money on demo, you won't make it on the live account. So check that out as well. Great way to play with that. So now let's jump on to an MT4 chart and I'll show you basically what an MT4 chart looks like. Most broker platforms allow you to download MT4. It's free as well. More recently, MT5 has been introduced as well. It's just a newer version of the MT4 with more bells and whistles. I'm not actually that familiar with it myself at the moment. I'm still on MT4 myself. But here is an example of an MT4 chart. Okay, so here's an example of an MT4 chart. So as I say, most of the brokers now will allow you to download this for free. You can have a demo or live. You can see here I've got a demo account. Any trades I put through won't be costing me or making me any real money. It's just for presentation purposes or practice purposes. You see lots of different profiles you can have as well here just by clicking down there. I can click on the Swiss franc, not much going on there. Market overview. I can have the British pound again up there with just one single chart. All these different indicators I can stick in by going to insert up the top here, clicking the indicators. I can put in oscillators and all the different oscillators are in there as well. Might want a MACD in there as well. Another MACD goes in there. So you put all these indicators in at your will. You can take them off as well. Very intuitive. You can also select to have different time periods. At the moment, this is the pound against the dollar on the 4-hour chart. I can move that to the daily chart. Looks slightly different, but it's the same price, just over a longer time period. I can have the 15-minute chart. Again, everything's updating instantly. I've got the 1-minute chart as well, for those of you that want to get down to the 1-minute chart. I can select to see price displayed in a different way. So at the moment here you've got the candlestick charts. I can look to have that as say the bar chart, line chart. More about that in a moment. I can make the screens bigger and of course make them smaller. What else we've got here? Basically you can you can insert your other programs as well that you may have, sort of some algos you may have to help you look for trading opportunities. Lots going on here. You can put on trend lines as well if you wanted to put trend lines on, and so forth. So a hell of a lot going on an MT4. Lots going on. I have done a video on MT4 as well. There is plenty of videos out there on YouTube on MT4 as well. But certainly you'll need a trading platform such as this if you indeed you want to get started in the Forex. And it doesn't cost you anything as well. You can literally set up an account. You don't need to put any money into the brokerage just to see if indeed this is for you as well. So this is basically what an MT4 chart will look like. The other thing with the MT4 chart, of course, is that you can trade on here as well. You can click to have one-click trading on and off with a little arrow at the top there. For example, now this is the pound against the dollar on the 30-minute chart. I can set my contract size here to whatever I wanted to do. If I wanted to have 0.15 of a lot, if I click on buy, that is basically sent a buy market order to the exchange. I've now bought the pound against the US dollar, and my profit and loss will be going up, and you can see that by going to your trading terminal up the top here, and you see all the different trades that we've got going on here at the moment, and the money is flowing in and out as the markets are moving. That trade we just put on was the pound against the dollar. At the moment it's just up 45 pence because the market hasn't really moved. Here you'll see the commissions in there as well. Not quite sure why I put that trade on. Shame, it's only a demo account, up £600 at the moment. There you go, it's a demo account. So that's basically that. There are other ways to enter the trades as well. Lots going on MT4 for a separate video, but do explore that. It's free to explore. Okay, so now let's look at the different chart types that we use when we're looking to analyze the markets. There's basically three that we look at. I'm going to just cover them now. I touched on them a moment ago when we were on the MT4 platform, but I just want to delve a little bit deeper into them, but not too much. I know we're whizzing through today's itinerary pretty quickly, so if it's going too fast, you can always pause and watch it back on catch up. First of all, we've got the bar chart. Bar chart basically shows us 4 bits of information. Shows us where the price is opened with a horizontal line to the left, high and low of that particular time period, be it a 5-minute time period or a daily time period, and the horizontal line to the right shows you where it closed in that particular time period. So for example, if this was a daily candle, that would be the close of that particular currency pair on the daily close. And then of course the next day would open up a new bar chart, and off it would go again, highs and lows as well. Now when you bunch all these together on a chart, it can give you a good clear picture of where prices may go. So it shows you the price at the start, prices at the end, and where the highs and lows were. Second one I'll talk about is the line chart. Now the line chart is good for a quick overview of where price has been in the past, gives you an overall picture of where the trend is. Quite good for plotting support and resistance. The line chart basically looks at the closing price. It takes away the high and the low, so it just looks at the closing price. So very good for support and resistance. You might have a resistance line coming in there, you may have a support line coming in there as well. Good for an overall view. Not that practical for entering trades, but very good for plotting support and resistance. Then you've got the candlestick chart. Mostly the most common form of chart analysis that we use is looking at the candlestick. Lots going on there, so let me just explain now exactly what is going on a candle. So here you can see an example of a couple of candles. I've got a red candle and a blue candle. Basically the red candle indicates that the price closed lower than where it opened. So I'll tell you exactly what's going on here. Prices are opening here. We trade up momentarily, hit a high down here. Then the sellers come in control, take the price down, and we close down here. It's a red candle. We know it's a red candle because it closed lower than where it opened. Here are a blue candle. Basically we open down here, trades to a low down there. Then the buyers come in control, take price all the way up to this high up here, and we close up here. This is a bullish candle. It's a bullish candle. It is a blue candle. Now you can change the color settings on those, but these are the standard industry standard colors that we use. Red for bearish candles, candles where price is going down, and blue for candles where price is going up. Now when you bunch all these together, or when you look at these in conjunction with other candles, they can give telling signs of where prices may go in the future. So as technical analysts, we're often looking at exactly this, the candlestick charts. And a couple of patterns that I like to look at basically are these. We've got the bullish engulfers here. When you see this normally at the bottom of a downtrend, it normally indicates that the prices may be wanting to reverse up, and indeed if you're seeing prices pulling down like this, And you see this type of pattern is a good indication that price is about to reverse back on itself. So these are great candles that we use for that. This is the bullish engulf, of course the bearish engulfer as well. We use these with trend and with counter trend as well. This is showing us that the markets are possibly continuing on down on a downtrend. So for example, if we're seeing a downtrend, okay, and we see this little blue candle come in here, and then it's dwarfed by this red candle, this bearish candle, bearish engulfer, that indicates that the trade wants to continue on back down. That is a bearish engulfing pattern as well. And then you've got the pin bars as well, bullish pin bars and bearish pin bars. We talk about these all the time in our trading room, so do come and join us if you want to learn more about them. And indeed, I've got some strategies out there on the YouTube channel which basically incorporate these as well. So those basically are the different chart types that we use. In particular, I pay attention to the candlestick chart. Okay, now let's look at the different order types that you can use when entering the market. Basically, there are two. You can use a market order or a limit order. Now, a market order is basically an order that's sent to the market the moment you hit your buy or your sell button on your mouse. So it basically executes instantly. Whereas a limit order basically executes in time. Now, you can have a buy stop order. A buy stop order would basically be used in a breakout, for example, normally above where the market is trading. So if the market's trading down here, for example, market's trading down here and you think it might go up, you might have a buy stop order above the market. If the market hits your buy stop, off you go and you're in the trade. And of course, conversely, if you're trading a sell stop order, prices may be trading here and trading down. You might have a sell stop order below where the current price is. If the market comes back down and hits your sell stop order, you would enter a trade here in anticipation of a trend continuation. That would be known as a sell stop order. And of course, if you're trading a buy limit order, if prices are trading around here, for example, and you think the market's coming down to your support zone, you may have a buy limit order below where the current market price is. So the market comes down, hits your buy limit order, your order is then executed in anticipation that the market moves back up and you can exit for a profit. And of course, a sell limit order would be the same, but of course in reverse. So markets are trading up. Okay, you may have a sell limit order above where the market price is, gets to your sell limit order, and you will basically enter a sell trade or short trade. It hits your limit. So a sell limit order placed above where the current market price is in anticipation that the market will be reversing back on themselves. So you normally use a buy limit order, sell limit order as well if you want to exit a position that you may be in already. And lastly, I want to mention this big red stop order, stop loss order. You see them at fairgrounds, you see them at machinery. You hit that stop button if you don't want any more damage done. Basically the same in trading. If you're in an open trade, you should always have a stop loss associated with it. So if you start to lose money, the maximum loss is predetermined on that trade. So you can't lose any more money. And sometimes you do get slippage, but more about that another time. But make sure you've got a stop loss in there to protect your trading account. Traders that don't use stop losses could often blow up trading accounts very, very quickly. We talk about stops all the time, and I encourage you to get used to using them. Strategies. What is a trading strategy? I think it's fair to say that most traders that come into the markets for the first time, they lose because they don't have a trading strategy. They're shooting from their hip. They're basically pulling the trigger just with no real rhyme or reason. A trading strategy is a must if you're going to be in this game for any period of time. What is a trading strategy? It's basically just a trading set of rules. When you're going to enter, when you're going to exit, the time frames that you're using. Are you using an anchor chart? Are you using the higher time frame analysis? You've got to have a set of trading rules written down, and that each time you trade that strategy, you've got a checkbox and you're ticking off the rules to make sure they comply with your strategy. The strategy's got to be back tested. Very important that you've back tested your strategy as well, so you've got the confidence in trading it when it goes through that drawdown period. Remember, all strategies, doesn't matter where you get it, all strategies will have drawdown periods when it starts to lose money. You've got to make sure that you've back tested the strategy on previous data so you know what the characteristics are of that strategy. Most importantly, you've got to have a strategy, got to be back tested. In that strategy, we'll also have the risk parameters as well, what you're prepared to risk on each trade that you are taking as well. So traders that without strategies are traders that generally lose money. Shooting from the hip is not the way to go when you're trading the markets, trading on a hunch. Risk management, position sizing is crucial for trading success, and this is very, very true indeed. Most people, when they come into trading for the first time, they don't consider risk. They just look at the profits that they can make. But as traders, we should always be conscious of the risk and always be aware of the risk and always be in control of the risk. Just because you've got a long trade, a buy trade, and you've got a stop below, if you need to have the stop lower down, it doesn't mean you're taking on more risk if you're position sizing correctly. It just means you reduce the size of the trade to accommodate a bigger stop. So position sizing is crucial to long-term success in trading. I suggest when you're trading, you should note risk no more than 1/4 or 0.5% of your account on any one trade, using the same percentage risk on each trade. Remember Einstein? He said a lot of things in his time, didn't he? Compound interest, it's the 8th wonder of the world. Those that understand it, they earn it. Those that don't, they pay it. If you've got a credit card, you know all about paying interest on a compound basis on your credit card. But basically, controlling risk is crucial. Now I'm going to show you on an MT4 price chart exactly what I mean by position sizing on a Forex trade. Okay, so here's an example. This is the Australian dollar against the Japanese yen. What I've done here, I've put on our risk management tool, which will basically do all the work for you. But it's simply here to illustrate how you should be controlling risk on each account using position sizing. What I've done here, I've set my default to 0.5%. This is quite a large account. It's only a demo account, by the way, as you know. So this is 0.5% I'm going to be risking on this account. Okay, I turn on the risk management tool. 0.5% of this account is about $500. Okay, it's $100,000 trading account. Of course, it is a demo account. What I do now, I look at my stop loss, which is the red line here. I move that down there. I move my profit target up there. What this does for me, it works out my risk reward. Basically means I'm risking $1 to make $1.57. Okay, it's going to basically still risk the 0.5%. It's moving slightly because of the spread, but it's only risking 0.5% of the account. But what it's done here is it's worked out the lot size for me. You see here it says 19. It's going to trade 0.19 of a lot. Now, of course, if I needed to have my stop further down, yeah, because markets may pull back even further, it's now changed my lot size to 0.10. So I'm trading a lesser lot size because my stop is further away. So just because you need a further away stop for the trade, it doesn't affect the risk on that particular trade. Still going to be risking just the $500 or 0.5% of this demo account, and as I say, it works out the risk reward for you. Now clearly, as you move the red line down, the stop loss order down, that's where you're going to get out of the losing trade. The risk reward ratio will change as well. Typically I like to have risk reward ratios of at least 1 to 1, so maybe up something like that, but I'll have my stops maybe a little bit lower down with the profit target trend continuation. But this shows you how the lot size should determine the risk, which shouldn't change because of the determined 0.5% that you've stipulated from the get-go. So changing the lot size to accommodate wider stops is the way you should be trading. The other thing about this tool, by the way, is also you can have a pending order as well. I can switch that in as well. So if I wanted to have my pending order, I can move my yellow line down there as well. So if the market pulls back down, hits my entry order, I can place the pending order. That goes into the market, and now that is being worked by the MT4 platform. It's actually gone to the broker. So my order is there waiting for a pullback. It is a demo account, so I'm going to leave it running. Right, all right, we're getting to the end now. Gosh, we're getting through a lot of content. Hopefully you are keeping up. As I say, you can always watch it back and pause the video as we go. This is like a whole trading course in 25 minutes. Psychology tips and challenges. Psychology is indeed the biggest challenge when it comes to trading. Most traders fail ultimately because they're not in control of their emotions, and the psychology gets the better of them. First thing you need to do is come in with realistic expectations. You're not going to give up your day job with a $100 or a $500 trading account. Should you start trading with a $500 account? Absolutely. If you can learn a skill, then of course that skill is scalable up, and if you can prove you can trade successfully, there's plenty of places that will throw money at you if you don't have access to funds. But have the realistic expectations. Don't think you're going to knock the ball out of the park each and every trade. You are going to have losing trades along the way. Start off with low leverage. You don't need massive leverage. If you can't make money on low leverage, then you're certainly not going to work or make money in the long run with high leverage. It certainly is the case. Using high leverage, I think, is the sure fast way to the poorhouse for most traders. No one trade should make you or break you. I see people out there checking their phones, looking at their screens all the time, looking at their trades, talking about it, asking me questions about it, because they're overly concerned about one trade. Have you seen my video out there? One of the best videos I think I've ever done here on the YouTube channel. It's called The Law of Large Numbers. One trade is irrelevant in the big scheme of things, and you should be thinking about that. Why are you bothered about one particular trade? It might win, it might lose. It's the law of large numbers, which is the most important thing. Here's a little challenge for you. Do the 25 trade challenge. I've just given you a brief outline there of how the Forex market works and how you can maybe start off trading. Get yourself a strategy, write it down, do some back testing, then do a 25 trade challenge. Make sure that you log the results, keep a journal of that strategy, do it for 25 times without fail. If you can't do that for 25 times, chances are your psychology, your mental makeup is not there for a trader at this moment, something you may be needing to work on. You'd be surprised the amount of people that can't follow their own strategy, let alone someone else's, for 25 times on the bounce. As I say, back test everything, back test, and then I put it there again, back test. To get your psychology on track, make sure you've got the confidence in the strategy that you're employing in the markets. Then when you have your losing periods, it's nothing to worry about. You've seen it all before in the past and it worked out all right in the end. So make sure you back test everything that you do. To use trade signals or not to use trade signals, I've seen lots of people certainly coming in to us sometimes expecting to follow a signal to give up your day job. Look, put it like this. No trade signal provider on the planet cares more about your money than you care about your money. So why would you entrust your hard-earned money with someone else? Trade signals certainly have a purpose in terms of learning a particular strategy, learning how someone is taking trades. You might make a bit of pocket change. I guarantee you, you follow a signal service and you're hitting some losing runs, losing trades, you are going to have a lack of confidence in that signal provider. You're going to jump out of him or her onto another one. You'll be in that proverbial cycle of doom before you know it. Following trade signals, following someone else doesn't have the longevity. That trade signal provider might be gone in a month's time. And then what are you going to do? Spend time, I think, focusing on learning how to trade for yourself. You can use ForexSignals or trading signals or other signals to complement that, but certainly not to rely on it. And I certainly wouldn't be giving up my day job by following someone else's. I often say to people who come to me, if there were such a signal provider, there would be no national debt of Venezuela. Central banks wouldn't have deficits. They would simply be there following a signal service and paying for their government debt and so forth. So be very careful of that. Let's summarize all this up. Basically, Forex market is the largest financial market on the planet today. The liquidity, the ease of access makes it very accessible for us as retail traders. You can start with as low as you wish or as big as you wish. You can start off small and build it up over time. Get the education, the education sorted out. Basics are really easy. I say we've got lots of education content on the basics. You can get that basically from us. You can get it on my YouTube channel. You can come over to the trading room. You join us in there as well. We talk about this all the time. So the basics are easy. Obviously, the mentality is much more the hurdle that you need to master as a trader. Have the right expectations. Follow me on the YouTube channel, and of course you can join our trading community as well here. Come and say hello. I think there's a trial as well. You can jump in. We've got a vibrant community. It's normally about 400 or 500 people in there at any one time, looking at trading opportunities, discussing markets, sharing their ideas and so forth. I know what it's like sitting here on my own in my home office, trading the markets for say 14 years really before I joined this education arena, and I know it's a lonely old business. Trading in a community really does help you along your way. It's going to be like having that private little mentor on your shoulder throughout the trading day. Remember this, I'm sure you've seen this triangle before. In fact, I had one of my team draw it up for me today. So, but it's basically something that's pretty common out there. People think it's all about strategy. People spend most of their time focusing on that, the strategy, hopping between strategy after strategy. Seen that video? You'll never make money trading the Forex market. 1.8 million views. It's the cycle of doom. People are getting strategies, chucking it out, trading it, moving around, tweaking it and all that. Strategy is not the be all and end all. Strategy, I reckon, is worth about 10%. Okay, risk management. Risk management is important. Risk management is very important. I mentioned a moment ago, risk management is it's crucial that you have the right risk management if you're considering making a career out of trading. And we'll talk about that in more detail, of course, if you join me and all that. But risk management isn't as important. I would say maybe about 20%. Isn't as important as your trader mindset, the psychology. Most traders fail because they haven't got this sorted out. It's worth about 70% of the whole pie as far as I'm concerned. That's, I think, where we come in and help you. Right, I don't know how long that took. I've got to look at the video now, see how long it was. I tried to go for about 25 minutes. I must be overshot it. If you liked the video, give me a thumbs up. If you didn't, give me a thumbs down. Don't forget to leave a comment. Let me know what you think. I do try and get back to them in due course. Also have a team helping me out there as well. Don't forget to follow us on Facebook. If you follow us on Facebook, we do stream live every Monday afternoon, 2 p.m. London time. But also now you can follow me live, 3 p.m. London time. That's the UK time, 3 p.m. Basically, I give a little overview of what I think you should be looking at for the week ahead. I also put a bit of education tips in there as well. We do that live, so you can interact with me on a one-to-one basis. I look forward to engaging with you there. Your chance to basically speak to me live as well. Of course, you can come and join us in the trading community if indeed you wish to. Thanks again. Until the next video, happy trading and good luck.